Hey, good morning, everybody. Welcome to RIA's Candid Coffee. What you're being told about annuities is wrong. So we've got a lot of questions on this. We're going to jump right in. But first of all, we are RIA advisors for Clarity Financial doing business as RIA advisors. Here in Houston, Texas, we are a registered investment advisor with the Securities and Exchange Commission. However, do not take this as gospel. This is an open conversation. These Candid Coffees, Rich and I created these during COVID just as an opportunity for people to ask questions, kind of talk about specific topics or what is going on. And that is the intent today. So in the comments, please ask questions. We're going to try to get to as many as we can. We typically try to keep these to right at an hour, but we're going to jump right in. Rich, you ready?
The most important thing to understand is annuities aren't for everybody, but you own one already. And we're going to get into that. And the most important thing to understand is annuities have been growing in popularity. When you look at total U.S. individual annuity sales, they increased 12% year over year. Retirement savers are hungering for income buffers and guarantees. And it's becoming more acclimated, with the Secure Act. So the biggest problem with annuities is they're sold. It's the salespeople who sell the annuities. And so as we go through your questions, we'll unravel some of this for you. But annuity is not a four-letter word, everybody. Okay? They are designed to fit into your overall retirement income picture. And as we get into this, Danny, we'll unfold where they could work. For some people, not everybody needs an additional annuity outside of what we call Social Security. But we'll get into that as we get into questions.
Yeah, and I think that's important. You know, it goes well beyond just annuities. I think any insurance, we look at long-term care. We're going to talk about that here in a couple months. We've talked about just life insurance in general. Any annuity or insurance product is generally, they can be great tools in a tool chest. However, they're typically oversold. They're not planned for. And that's where I think, going back to, and I know I sound like a broken record here, but the planning element of it all is so crucial. I mean, how many times do you know where somebody says, oh, well, we've got to replace all of your income, so we're going to put every dollar you have into an annuity, or you're going to need long-term care. It's going to cost you X amount. You have to spend, you need to put this much in to get this much back out, not thinking about they already have Social Security. They may have a pension. They have other assets. So really you may need something to subsidize or to help, utilize your assets more as a legacy tool down the road. And so you need to think about that with the annuity element. Is what are the three reasons you would use an annuity, Rich?
I don't know how you can buy an annuity or insurance of any kind without looking at a holistic picture of your finances. Yeah, you can get sold an annuity all day, but you're going to get oversold, and then you're going to hate the product. And Danny has experienced this, where there are all these bells and whistles that get added on to the core annuity called riders that actually cost more money. And a lot of times people, one, don't know they have riders or attachments. It's like having this fancy radio in your car you didn't know you had, and you didn't even need because you don't listen to it. So people don't know they have them, or they're spending too much on them and they don't need them. So the whole spirit of annuities is longevity risk management. So that's when you would need it. One, I run a plan and find out that my variable assets like stocks and bonds are not going to live as long as I am. That's one reason why I might add a guaranteed income structure into the program of my overall picture. The other reason might be, hey, I feel like markets might, over the next decade, may not return as good as they are. And I would rather depend more on guaranteed income for my fixed expenses to cover what I need to survive every day, and use my variable assets like stocks and bonds as discretionary spending, the fun stuff. That's another way to look at it. And there were some people, we know them, Danny, they're just too risk averse. They don't want to be in stocks and bonds. Therefore, they do utilize annuities to provide income to them. Or I don't have a pension and I have to create my own pension. So those are a few reasons why you might look at an annuity structure to complement your overall retirement income strategy.
Yeah. So, I mean, really, you break it down, it's for preservation of capital would be one, right? You could use what we call a multi-year guarantee annuity or even a fixed indexed annuity, which would be something that will have a buffer or a cap on the upside, but typically will limit you to zero downside. So that could be a great example for somebody that would not probably wants to be in the market, wants to beat, what fixed income returns are, however, does not want the risk. And I'd be cautious. Any of these I would only use for a small amount. And you can dial in and kind of back into these is what you should ideally do. The other element would be that longevity, like you just mentioned, the longevity element or a death benefit. So, protection, income, death benefit.
Or say, for example, I want to leave a big legacy to my heirs. And I decide, listen, I'm going to tap this variable asset stuff sparingly because I want to leave the bulk of my estate to my children and my grandchildren. That's where insurance and annuities could come into play for you.
Yeah. So what are some of the things that you see that people do wrong with annuities? I think this is a big question that you see these a lot, right? A lot of people have them. There's frustration around them way too frequently. I mean, I think the frustration is warranted in some cases, a lot of times, but how many times, especially back, I can think like 15, 20 years ago, especially when you were getting these, these, especially like variable annuities, 7% returns. Oh, I'm got locked in 7%. Like, wait, can you explain this to me? Right. And most of the time, most people thought they were getting 7%, but they didn't realize they could not walk away with that. That was 7% on an income base. So when we're talking about a lot of these different annuities, there's an element that is going to be, like if you have an income rider, well, that's going to look different than what your surrender value is and what you can walk away, or your cash value about balance, right? And so it really is essential to pay attention to this. And then if you are going to have something with an income rider, my thought, if I'm going to buy one of these for myself, is that I am not touching those funds again. If I've done this and this is going to work the way I anticipate, then ideally long term, you should be able to utilize those funds, let them grow, get the benefit of the income rider, which will go up by a set amount every year, regardless of the market. And then you turn that on to supplement income in retirement. But too often, most people think they can walk away with that income stream.
So I do a lot of work with an AM station here in town, Houston, and they discuss they're promoting a 10% rate of return on an annuity. And that's enticing when you hear a commercial, and the commercial sort of teases the other advisors that might be listening. Like, if your advisor tells you that that doesn't exist, he or she is wrong. So to Danny's point, if you have an annuity, it doesn't necessarily mean you need to annuitize it or turn it into lifetime income. You just might hold, like, for example, Danny talked about fixed indexed annuities. I own a couple of those. They could be good replacements for bonds. They could be just a part of your overall portfolio sleeve, because what I know with a fixed indexed annuity, which is probably one of the lower cost annuities, which is absolutely true, not probably, you have the ability to go ahead. This is live, everybody, so you're going to hear dogs and all kinds of stuff. Chasing squirrels and cats and whatever else is in the neighborhood.
Yeah, that's right.
So I have one annuity that has a 7.5% rate of return. And what that means, when you hear that kind of large number that perks your ears away to, like, what? Did they say 7, 10%? You are literally giving that money at a period of time to the insurance company. And what they're doing is they're going to create an income base from it. So say I give them $100,000. They will adjust. That is theirs now. If you're going to take income, that's theirs. And they're going to create this income base. So you might get, might be worth 110,000, might be worth 150. What then happens is there's a withdrawal rate that comes out of that bucket over time. But to Danny's point, if I in my mind, if I hear 7 to 10% return, that means I can get my money out at any time.
Which is typically just not the case, right?
I can. So to your point, fixed indexed annuities with riders, SPIA annuities, all of that are designed to bet on your longevity. And some of you listen, some of you seem to know when you're going to die. I don't know how. You really do know. Like I ask, do you know? Oh, well, I'm not going to live past 70. It's, how do you know?
If we all knew our expiration date, planning would be so much easier.
Wouldn't it? So you got to remember with technology today, what's going on in AI, what's going on in healthcare, you're probably going to live longer than your parents and your grandparents did. I think the life expectancy in the US just hit a new high.
Yeah.
Not too long ago. So what I'm saying is annuities can be cut and put together in a lot of different ways to create exactly what you need. The problem is you're going in for like a Dodge car and they're giving you a Mercedes when you don't need one. And listen, I had a conversation with someone the other day who absolutely didn't need annuities, but wanted one so badly. And I can't figure out why. They absolutely have enough income to make it. They have Social Security. They took it the right way, but they are convinced they need an annuity from some guy at Edward Jones. As a fiduciary, and we offer annuities, full disclosure, I'm like, you don't need an annuity. Why are you doing this? At 80 years old, why are we doing this? Doesn't make any sense. So there are people that either hate annuities or they love annuities. And to your point, Danny, we're somewhere in the middle based on where the planning tells you to go.
Well, and I think something that's important is you got to think about the age and how you're using it, what type of tool it's going to be, right? There's a lot of different types of annuities. And if you have one that is going to provide an income stream per se, we want them to give us that guaranteed, that 7% or 10% you just mentioned that was advertised. You want to get that until they stop paying you that, right? Then you want to turn on the income, ideally, in a perfect situation. It's not always. You may say, hey, I have a 5-year time frame, and this would be a deferred income annuity is what we're referencing right here. But you also want to live long enough. In an income annuity, the objective should be for you to run out of your money so that you're utilizing the insurance carrier's money. And usually, depending on the policy, it's about 14 to 17, 18 years. And so if you're 80, you better have a very high conviction that you're going to live to 100 so that you're actually getting all that you can out of it. Now, keep in mind, many of these don't, they're not going to be inflation adjusted. Most of them are not. You can get some compounding if you're getting distributions. I mean, there are a handful of different types of annuities. Maybe we should spend a little time on that. I know we're kind of just jumping around. I'm seeing questions come in. We're going to get to those.
Annuities are incomes for life. And frankly, if you're sitting in with us this morning, and we really greatly appreciate this, you probably are good savers and good stewards of your money. Odds are good. But there are a lot of people who have not saved enough at all for retirement. So they are at risk of outliving their money. And an annuity structure for them to hook into Social Security could be a very good thing for them. For people who are probably on this, annuities are part of your overall strategy. So let's talk about the most basic type of annuity, Danny, that everybody has, whether they want it or not, generally. Social Security.
Mm-hmm.
Sometimes you don't have to purchase an annuity from an insurance
You're already
company.
doing it.
You already got one, but you want to make sure, what are you doing? You're maxing out what you're going to get for you and your spouse. So the right claiming strategy for Social Security can reduce the need for an annuity. It absolutely can, right? So this is, again, where the planning comes from. So Social Security is your annuity, by the way. If you have a pension, which is rare, but people do, that is an annuity. Outside of those two is when you start branching out into all, to Danny's point, the world of annuities, fixed indexed annuities, variable annuities, annuities that start right away, annuities that don't start in 10 years. And you know what, Danny? They add more bells and whistles to annuities every year, formulas. My annuities are linked to 3 indexes, one being a JP Morgan index, one it's a Deutsche Bank. I'm hoping that that income base that I put down is going to grow, because you said a lot of these are not inflation indexed. So you can own subcomponents in several annuities. The good part about it for people that don't want to take market risk but want to participate, we have a retirement income guide we'll talk about later. But I call fixed indexed annuities the cake and eat it too. Because there are points where you might say, well, I'm going to put it all in an S&P index within my annuity. And and you said it earlier, if the S&P does 10%, I may only get 5. But if the index is down 20%, I don't get anything. But that downside risk of 0 is really appealing for a lot of people. You really get compounding in that through that period, don't you?
Yeah, I think that, that's an element where you touched on it a bit earlier. If psychologically investing is difficult for somebody, that could be a great tool, a great way to utilize to get the funds to try to beat inflation. I mean, you guys listen to Lance, you hear Lance speak about it often. What's the number one goal? You want to keep up and beat inflation. We want to keep up with it. You beat it, you're in a great place. Preserve funds, mitigate risk. And that is a way to do it. It's not for everybody. But if you're adverse to those types of things, especially large pullbacks, I mean, what do we talk about with the market? What's the price of admittance? You should be prepared for a 10% decline.
We had a really good question from Marie, about QLACs, qualified longevity contracts. They are, keep in mind, these qualified longevity annuity contracts are now getting coupled into retirement plans. This is part of what the Secure Act tried to do, because more and more people are looking for this. So you can purchase, in many cases, part of your retirement funds, your IRA, your 401k, into a deferred income annuity. I think the limit's up to 210,000 for last year. So you use your funds from your IRA or 401k, 403b. Most likely there's offered within your program. And you can say, I want to put that in there. What's cool about QLACs, it allows you to delay retirement minimum distributions until age 85. So you're getting a guaranteed pension-like lifetime income starting later in life and mitigating the risk of your outliving your savings. So Marie, first of all, you got to see is, does your plan offer QLAC? It's the funds are locked up. You can't reverse the decision. You can't get your money back. So you want to make sure that you're going and talking to a financial advisor who helps you understand of how much you want to look at a qualified longevity annuity contract. So these are a very, if there's longevity risk in your family and you want to complement Social Security, or what did I say earlier? Why were these created? 1, we're living longer. 2, most people are not good stewards like you, Marie, and others on this call. Therefore, that is going to be their primary source of income and the mitigation of longevity risk. That is why they have been added to plans. So you got to look at your own self, your longevity, how much risk you're willing to take, and decide, can I put a portion, or do I want to put a portion of this money in my retirement accounts into a QLAC? For a lot of people, I think it makes great sense, Danny. to do that. And I think that was a very intelligent question and good question, Marie, because that's part of the
step back though,
Secure
Rich.
Act 2.0.
Yeah, for everybody that's not familiar with the QLAC, what's the main purpose of why you'd use one?
Longevity risk and lifetime income. Longevity risk, that's your biggest issue.
But also deferral of RMDs.
Oh, yeah, right. Well, that's a nice
what most
benefit.
people are
But the
looking at,
reason
right?
I'm really owning this thing, I don't even like to focus on that, but you're right. You're right.
But I think that's what comes up most often is that people are like, how can I not take RMDs? How can I get around it? That's just one loophole or avenue.
Yes. But what did we say earlier about annuities? You don't get tempted by your 10% rate of return. You don't get tempted by the fact that maybe with a QLAC, I can wait until 85 to take RMDs. I am concerned about one, outliving my money, or two, I want to leave a legacy, or it bothers me to be on a pure spend down mode. So I'll give you an example, real life example. We have clients that have annuities or pensions that they bought. We review those for them. As fiduciaries, we will tell you, this is a good annuity. Don't do anything with it. You might be missing something. I think you had helped so many people, Danny, that were missing out on their riders for income. They didn't, because once you get sold this annuity, this insurance person seems to be gone. I am sure there are insurance people out there who are not like that. My experience, and that's why annuities get a bad rap, is once these things get sold and usually oversold, you never hear from this individual again. Do you know within an annuity like your 401k, for most annuities, you have buckets. You have buckets of different investments, and those need to be rebalanced every year. And I bet, I dare to say, maybe in the chat, you all have a great insurance person that calls you every year, or you can call them and say, what do I do? As opposed to just letting it ride. So the QLAC, I think the spirit of it, Danny, is showing that people are worried they're going to outlive their money. And I think this is one of the better parts of the Secure Act 2.0. Overall, you can create your own QLAC outside your plan, but since most people auto contribute, you're allowed the QLAC. But talk to your financial advisor about how much you maybe want to put in there. But anything else you want to add on the QLAC before we beat it to death?
No, I think that's good. I just wanted to make sure we took a step back so everybody kind of understood, because they're not as prevalent in most cases. When somebody, we have people who bring that up to us and like, hey, should I use a QLAC? But usually it's for delaying RMDs is what they're thinking, right? Not the longevity element.
They are. I agree.
But, going back to, you touched on something, and I actually visited with somebody last week and talking about, a lot of times somebody sells you an annuity and boom, they're gone. I visited with somebody, they had a fixed indexed annuity and they were charging them a 1.5% management fee on top of the annuity. Okay. So this person was literally going in once a year and making a change and charging a management fee. So you have to be careful because fees can add up. You need to understand what you're getting into, read the fine print. A lot of annuities can be very expensive, which is what they get a bad rap. The fixed index, those fees are all baked in internal. MIGAs, multi-year guarantee annuities are, the most similar thing people hate. The industry hates anybody saying this, but they're most similar to a CD. Fixed rate of return from an insurance company. You've got to understand what you're getting into, what your time constraints are. There's a surrender charge associated with it. Sometimes, you may sign up for a 10 or 15 year annuity and not realize it. So be cautious on that. Make sure you understand that element of it. Real quick before we jump into the next question, though, Rich, we are going to give out some canned coffee mugs. So, Brent, if you would please pull up the Wheel of Fortune, spin the wheel.
Let's spin the wheel. What do we got?
Usually we're picking a name out of a hat. You guys have gotten so technologically advanced. This is great. Steve, we will reach out, get your information. We will send you a mug. Congrats. So is a portion that is taxable, not return of capital, determined by the annuity policy itself, or is the discretion allowed by the CPA? And actually, Connie, I think you answered this one well. So if you don't know Connie Mack is Rich and our partner. He is in the building. And so this is a great answer, Connie. So when the annuity is annuitized, the policy determines the taxation. If you're taking withdrawals, and the CPA can choose LIFO or FIFO, which means last in, first out, or first in, first out. This assumes on non-qualified assets. So meaning not an IRA. If it's in an IRA, you do have to think about this. If you're utilizing an annuity inside of an IRA, it's kind of like walking in your house with an umbrella. You don't necessarily need it for the tax deferred element. You're doing it for other specific reasons. But every dollar would be taxed inside of an IRA or qualified account when you make a distribution. What we're referencing here is that last in, first out, meaning that your earnings or your interest that's paid into it, that is typically taxed first. First in, first out would mean that the proceeds you contributed of after-tax funds would look like you're taking those distributions first.
You got to be careful of taxation because most policies are LIFO. If I was going to take, say, I had 100,000 in annuity, now it's worth 130. I want to take money out. I want to take a withdrawal. I need cash. Hopefully, I'm past surrender charges, which is a period of time you need to hold them, and you're penalized for taking money out. That's all usually LIFO. But I think this question was based more on annuitization structure. So appreciate that, Connie, overall.
Jennifer, any strategies for couples in which one partner has chronic illness and one does not? Is there a way that an annuity can help safely free up some fund money in earlier pre-retirement without imperiling the healthier spouse in their later years? Yes and no. You got to be careful here. And I think the one thing is, and somebody mentioned this earlier, like when's a good time to buy an annuity? And yes, you can buy them in your 40s and 50s, but even with non-qualified funds. So think about, you have money in your checking account or your savings account. You want to go put this and purchase an annuity. You're going to want to wait until 59 and a half in most cases. There is one loophole to get proceeds out beforehand without a 10% penalty. But because it is a tax-deferred product, the IRS looks at these vehicles and will penalize you 10% on distributions prior to 59 and a half.
So Jennifer, here's how I would look at it. The annuity is for the person who's going to live longer, right? What you're saying is, hey, if I have one spouse, God forbid, that's chronically ill, may not live as long as I do, but we want to do certain things, could the annuity allow me to do that? It could, because I know when I buy that annuity, I am in the future secure with my income, or at least more secure than it would be, which may allow me to spend down some of my variable assets first to have some fun. In other words, I don't want to use that annuity for fun. I want to hold that for my paycheck in the future. But I might have a little more spending up front, and I'm okay with that because guess what? I don't need these variable assets as much for income because I'm going to focus more on the annuity. You got to figure out what formula looks right for both of you and your spending habits before retirement or in retirement, or one in retirement who is not going to live as long as you. So we got to work the numbers. But the spirit of your question is absolutely right. The more money, there's a study out there. See if this makes sense to all of you. People who have guaranteed income spend more. People with guaranteed income spend more. Think about it just intuitively. If I have a check coming in for $4,000 a month in January, I can go to zero because I know in February I'm getting another check. People with variable assets alone, like stocks and bonds, tend to underspend. Why? If there's a 10 to 20% move in the market downside for you, even though your portfolio is not getting as hurt, do you think maybe you would adjust your withdrawal rate? Say, ooh, I feel nervous. I don't think I'm going to touch this right now. Well, what are you going to do? If I have an annuity, guess what? I can leave those assets alone to work through that correction. Chris has a question. Does income from annuity penalize you in terms of Medicare premiums? Another good, man, you people are sharp this morning. You wanna tackle that one first?
Yeah, so
Daniel?
any income is going to be included for Medicare premiums. So what Chris is referencing here is IRMA. And so basically, you're going to have your normal premiums on your Part B and your Part D. If you make too much money, you're going to be paying more. And so, so everybody's always concerned about means testing. This is means testing in its finest. So if you have too much income, your IRMA will, or your Medicare premiums will increase. So for this year, I'll pull up the brackets here and show you guys. Let's see.
So while Danny is doing that, keep in mind, to your point, a lot of annuities are LIFO. And they used to be, before, I think it was 1983 or 1986, there would be a FIFO in there, VFIFO. But keep in mind that yes, a good portion of probably what you're taking out of your annuity is going to be considered ordinary income. And you got to be real careful because, yes, you will get these Medicare charges for you in a couple of years from now. This is the
so keep in mind right here. So it says if your MAGI, modified adjusted gross income in 2024 was, and I think this is important, this throws a lot of people off. When we're considering Medicare premiums, they're looking 2 years backwards. So they're going to do a look back period of 2 years time frame. And you may say, well, I'm not that concerned with it. So really, if you're looking at Roth conversions, if you're looking at all these things, and there are times when we do conversion analysis that we'll actually advocate to go into IRMA and pay a little bit of additional premiums. But there are some people that just say, I absolutely don't want to give them any more money than I have to. I want to be under IRMA. Well, then this is the chart that we would be considering. And so for 2024, if you're married filing jointly, was under 218,000, you're paying 202.90. Now, here's the kicker too. This is for both of you. This is just, if you're married, this is for you and your spouse. So if you get up, this is not a graduated this is more of a cliff.
It's a cliff
Taxation, right? If you get to $218,000.01, both of your premiums are increasing by $81.20. So if you get over 274, it's going to go up to 202. That's the increase. So your total amount would be 405.80 for each of you. So this is something to be considered. There is something called an SSA 44. If you had a life-changing event, you can actually go out and utilize that form to go and fight that. And so this would be that form, type of life-changing event: marriage, divorce, annulment, death of your spouse, work stoppage, work reduction, which are typically the more common ones we've seen, loss of income producing property, loss of pension income, employer settlement payment. So if any of those things occurred, you can go in and say, well, here's what I believe my income is going to be in the following years. Now, keep in mind, when we're talking about income here, they're talking about all sources of income. So not just your, Social Security, pension. This is going to be capital gains. This is going to be municipal bond interest. So your tax-free interest is going to be included in this for this calculation. So be careful there. So yes, all income will be considered for Medicare premiums. Certainly something that needs to be or should be considered when you're making these types of decisions.
So Glenn is looking at fixed income annuities from Fidelity, right? I want to get a slighter higher rate. I have no interest in annuitizing, just rolling them into an annuity when they mature, non-qualified funds. I don't think there's anything wrong with this strategy, except for the fact there's this tax impact at the end, but obviously you pay interest on a CD anyway. So if you're remember, annuities are lifetime income, but they could be a part of your portfolio that you hold. As example, I have fixed indexed annuities. I could use, instead of laddering bonds in my portfolio, I might ladder. I'm working with a client right now because he would rather ladder fixed indexed annuities as opposed to bonds and trying to capture some upside of the market. That's not a bad strategy. So the only thing I would say, Glenn, is instead of doing that every year, like my grandma used to shop for CDs at every bank in Brooklyn, you might look at like a fixed indexed annuity where you can participate in underlying growth at least, and not have to roll it over so much. Look at something that's tied to the market and adjust it every year on your anniversary date to see what's available and let it sit there for 10 years. If you don't need the money, if you're looking at it as, hey, I might eventually need the money, it's different. There's nothing wrong with the strategy. It's just might be a little bit more time consuming, but if you're willing to do it, I don't see any problem with that.
The one things I would think about is, one, you hit on it a little bit, was all of these are going to be deferred, the income that's coming in. So if you say, you know what, I've had enough, I'm not going to do these anymore, I don't need them, they're too much to keep up with, I'm going to go ahead and just pull the funds out, you're going to be taxed on all that interest. It will be taxed as ordinary income. It will impact IRMA. So do consider that element of it. They also, some of these companies, instead of just saying, hey, you're out of surrender, you can get your hands on these funds whenever you want. Many times they'll roll over into a new one. So you need to be mindful of the window they give you to say, hey, I can make a decision. I can move this and do a 1035 exchange into another product and continue to delay or defer the taxes on this. Or I'm good with keeping one here, but I want to make sure I get the best one they have, because many times they're just going to roll you into something and it may not be the best yield that they have if you're just looking for rates alone.
Let's talk about this a little bit. Glenn brought up a good point because he says he owns this money in non-qualified funds. So keep in mind, right? Income that you own in an annuity is tax deferred and comes out as ordinary income, to your point, Danny. I like non-qualified annuities, which means they're not purchased with IRA funds. The thing is, most people have IRA funds, so you're duplicating tax deferral. But Glenn, what I would do is keep track of what you've put in as return of capital versus earnings. So at least when you liquidate this, not 100% of it is going to be taxed as ordinary income, because you funded these with non-qualified funds, and that means non-IRA, non-tax deferred funds. So that is also not bad. The tax hit may not be as bad for you, but to Danny's point, you need to know your exclusion ratio, or know what percentage over time, if you keep spiraling and doing this, what is return of principal? What does that calculation look like every time I get a payment from this annuity?
But you could also utilize this to your advantage, that tax deferral, because you have other income coming in and it's going to put you near one of these brackets for IRMA. You may want to defer some income.
Right, and this is a way to do that. As opposed to putting your IRA on. It's like an IRA annuity is like wearing two suits. But what people will sometimes do is use bonds as replacement, use those as bond replacements, or and they want that downside mitigation. They don't want to take a lot of risk. So for some people, the tax deferred element of it is not important. But yes, you're absolutely right, Danny.
Yeah, and then be careful with riders. I do think that there's a lot of people get sold riders that they're not intending to use. So kind of back to that question on, I'm using it for specifically this, I'm not intending on taking income from it. I think that's an important element. Joseph, this one here, all things being equal, better to get an annuity at a younger age, even if COLA rider is not available below age 50. Potentially, just be mindful of the 59.5 rule. On these funds, you could do what they call a 72T, which allows you to take equal and systematic payments for up to 5 years or until you're 59.5, whichever is greater. So you need to do, be careful. And I'd only typically do that with a portion, because you don't want to mess that up. If not, you get that penalty and it hits you pretty hard.
Yeah. So your COLA rider is sometimes in an annuity is really just investing in these underlying sleeves that can grow, right? If I'm tied to an S&P index or a value index, there's so many indexes inside annuities now. It's like as many choices that you have in your 401k, you almost have in your annuity.
Yeah.
But that's a way for you to provide COLA protection in a way, if you look at fixed index type annuities.
So switching gears here, this is great, I think. So Marie is going to delay Social Security until 70. but would like income, this can be fantastic in the sense that you could do an immediate income annuity. So a lot of times they call them SPIAs or SPIA, single premium immediate annuities. And you can do those for your life. You can do it joint. You can do it for what we'd call period certain. So let's say you're 62, you're retired, and you want to duplicate the income that you would get from Social Security until 70 because you're going to delay Social Security. This would be a way that you could do so. Now, keep in mind that the funds will be completely liquidated and they're going to be gone when you're done with it, but you're going to be able to get a better return than had you just put it in a savings and just drew it down.
What Marie is doing is she is finding a way to maximize her Social Security first. Very smart, right? I understand everybody thinks Social Security is going away and it's not going to be there for you. It will be there for you. And it's cost of living adjusted. So she is doing the right thing by either using an annuity structure or even taking money out of her retirement accounts up to the period where her Social Security kicks in. See, what's complicated, Danny, about annuities, right, is you got to not only worry about the riders, the choices within an annuity, the types of annuity, you also have to really be concerned about the taxation of withdrawals. And I don't know a lot of life or insurance people that talk about that.
No, because it's an element they typically won't have to deal with. And that's the problem with many of these when they're sold and they're not planned for. Visited with a client a while back and they said, hey, take a look at my mother's annuity. And so going on, you mentioned kind of the bells associated with it. So there's many bells and whistles. They had a variable annuity that was done 15, 20 years ago. It had a death benefit. It had an income rider. The client was in her very early, or the mother was in her very early 90s. And we looked at the M&A, so mortality and expense ratio, and added all of the bells and whistles up. And they were paying near 5% a year. He was wondering, he's like, why hasn't this grown more? I said, well, you got to beat 5% just to make any money. And so, well, should we turn these riders on now? I said, probably not, because you have this death benefit and you're never going to eat into it. I mean, at this point, and it really stinks because it was not utilized properly. So when you have these, have a game plan. Make sure you're writing down and making, put it on your calendar. Hey, what age do I need to turn this on to potentially get the most bang for my buck out of it, if you're going to do so? And no, you could have duplicate riders, duplicate things on there, or multiple, probably shouldn't say duplicate, that will impact and erode returns on something like that. So just something else to consider.
Back in 1998, and he was 75 years old. And annuities work off actuarial programs, right? So every few months I'll hear from him. And because he's pretty much lives off only the annuities now. He goes, I'm beating the insurance company because remember, he's gotten paid a long time ago. That insurance company wanted him to die at 75, right? Now he's over 95, or 94, 95 years old. And he goes, look at the, that increases his rate of return, right? Because they gave him back his principal a long time ago. So now he lives off that. So that SPIA turned out to be one of the best purchases he ever made. From I'm showcasing a longevity risk example here of the beauty of annuities when they shine is when you outlive the mortality tables. And that's what the insurance company doesn't want. But you're saying, I dare you, I am going to do it.
Yep. All right, Rick, we're going to get to this question now. So approximately what end of year balance on your IRA with average Social Security about $2,500 a month will RMD start affecting IRMA? That is a difficult question to answer because we need to know everything else that you have. And your, number one, it's IRMA or your RMD is going to be considered, it's going to be based on your age and your end of year balance. So if you pull up a uniform life table from the IRS, you could see exactly what you're going to have to distribute. You take your December 31st balance from that, and then you divide it by that number, and it'll give you like the first year's 3.7%, give or take. The following year, it goes up. So the idea behind that is the IRS wants you to spend your last dollar based on those mortality tables when you have one foot in the grave. And so it will go up each year, but it also, so IRMA is so difficult. So like this year, if you are married, Rick, and married filing jointly, it's going to be $218,000 is what that number is going to be. So we'll have to consider all other income that you have. And then, you can determine what that looks like.
Having to play this income game in retirement to minimize IRMA, because the theory was when I first started in this business, when I took my horse and buggy to take my tests, you fell to the lowest tax bracket. Like, in other words, most people when they retired went and fell to the bottom of brackets. That doesn't happen anymore. Not for a majority of retirees, especially this group. Taxes will always be a thorn in your side in retirement. And that has to be managed properly. So every investment you add is going to create an impact to that. So that's, Rick, what you have to keep in mind. What goes into that? If you have been placing all your money in IRAs for your whole life, in retirement plans, because that's what you were told, when you retire, you are going to create an ordinary income event that probably will trigger that IRMA. And at the least, have 85% of your Social Security taxed. So those are things to keep in mind when you're crafting a retirement income paycheck overall. So it was a good question because I understood the question, but behind that, you got to remember, it's a good thing to worry about because you may not think, you might be in a higher bracket than you think.
Yeah, Daniel, I'm going to get to your question in just one second.
Yeah,
I'm going to touch on one more thing with Rick here. So a couple things you should be considering. So number one, if you're not at required minimum distribution age, that age has changed from 70 and a half to 73. In 2033, it will go to 75. You may want to consider doing Roth conversions now. Another thing, if you're charitably inclined, you give money to a church, the shelter, whatever it may be, a 501c3, you could do a qualified charitable distribution directly from your IRA. So if you're giving money to a charity out of you're writing them a check, you could do so from your RMD to reduce your income, and it'll be dollar for dollar, right? You're going to have to take the money out, but you're not going to have to pay taxes on it. So something that you should consider, kind of ways around that. But a conversion could be a very good tool to do before you get to RMD age. Or if you're already there and you're charitably inclined, utilize a qualified charitable distribution, a QCD. All right, we're going to jump into Daniel's question here. I have a company pension option as a lump sum when I terminate at 65. Hurdle is low if I take a lump sum, invest, and or buy a QLAC with death benefit. So this is one where you really need to do your homework. Number one, is your pension tied to interest rates? Meaning that if rates go down, will your lump sum go up? If rates go up, will your lump sum go down? Sometimes this is about timing. Just a couple years ago, when we had a lot of interest rates shot to the moon after COVID, we had a lot of clients who actually retired earlier because they said, wow, my pension payout, they were determined to take a lump sum. They would be working for free with the amount if they estimated it going down. They were going to work for free over that time frame. They said, I'm going to go ahead and retire. There's no sense. So you need to understand the ins and outs of that. You can actually get that from the provider. They'll give you they're required each year to send out some documents. They're going to show you how well funded the pension is, but you can also typically determine what is it tied to. And sometimes they have a formula on what it's tied to. Sometimes they're not tied to anything. It's just set. But understand that. We are also able to go out on the secondary market during that time frame and find an annuity that would actually beat what you're getting from the pension if you turn that on. You said, hey, I like the lump sum element of it. I don't want to set up the pension, but I do want to have guaranteed income. And here's another con. And I can make, we look at these very pragmatically, and we can make a very good determination on best options, like looking at a lump sum over here, looking at doing a, taking the actual pension. And then sometimes you may get a little bit less if you actually went and bought an annuity, like an immediate single premium immediate annuity. However, some people would still do that because if you start that pension, you receive one payment, and it's just say it's a joint contract, or it's just on you, it's a single. If you die, or you and your spouse both die, God forbid you're hit by a bus, whatever happens, those funds are gone. So if you do have legacy intent, a lot of people will take that lump sum simply because of that. But sometimes it's a longevity issue. It's a can you meet your monthly expense issue? So you need to look at all different variables of it.
One of the things I will say is if I'm looking to leave a legacy to my family, like I want to keep my IRA intact, and we can talk about the negatives of having your child inherit your IRA in a later time, but you want to remember that if I do this, if I take a guaranteed income structure, I can leave a lot of those assets alone. And I want to take I may want to take, to your point, I may want to take the assets out of the pension and move them to an IRA, which will get inherited, and then find a way to create more guaranteed income within it for a portion of it. So you can replicate or try to replicate what you were going to do in the pension through the private markets, for sure. Yeah. We do that homework for you, right? What's better? Lump sum. Sometimes it's qualitative too, not just quantitative.
It's a lot of times it's qualitative.
Yes.
But all right, can you put an annuity in a Roth to avoid taxes? You can absolutely put an annuity in a Roth. You've got to be careful on the tax element of it. Do you really want those funds? And what I mean by that is that if I have different assets, if I have a Roth and I'm not going to pull from it, that is probably like, let's say, Michael, you have a Roth, a traditional IRA, you have non-qualified assets that you have invested, and you own stocks, bonds, mutual funds, ETFs, whatever vehicle may be, and you have an annuity. Is an annuity or a more conservative investment the right thing to put inside of a Roth? If I am going to think of it that way, I may want to have a more aggressive asset inside of the Roth for the growth element if I'm not utilizing that for income, at least not now. So you may want to think about just, we talk about diversification of assets. Rich and I talk often about diversification of accounts and what is the best place to put proceeds and how you should use them. So what is your allocation? What's the diversification of your allocation, more or less?
Yeah, this is a interesting question because yes, you can do it. To your point, Danny, I always wonder about why. Unless I'm really frightened, I need a guaranteed income, but my Roth should be pretty aggressive. That's my opinion. My Roth should be the legacy asset, to your point, where I want to leave that Roth to my family as an inheritance. And if I need the money in the future, it's there for me. So can you do it? Yeah. Can I understand the reasons why you want fixed income over your lifetime? You have longevity risk. I understand all the reasons for it. I just think there's probably a better way to do it. But yes, you absolutely can do that.
Yeah, so that's a great point you just mentioned from the legacy aspect. So Secure Act 2.0, you alluded to it a bit ago. It made some changes. So your heirs are going to have to take, so your spouse will pick up your account just like it's their own. Your heirs will have to take the funds out within a 10-year window.
Generally, yes, that's right.
That can be another reason why a Roth can be really important, and you want to utilize that for the legacy tool, because while they'll still have to take it out within 10 years, it will not be taxable. So listen,
I know we're going to get to the end of this and we're going to lose some people. So I want to explain to you, we've got some really good stuff at realinvestmentadvice.com. We produced 2 ebooks. One, which is my favorite because I wrote it. I wrote 2 of them, but this one's my favorite. Retirement Income, how to craft maximum retirement income. And it shows you the mosaic of retirement income, where how do annuities fit? What's out there and how do annuities fit into my program? So this gives you really good education on that. These guides are free. Just put in your email information and we get it downloaded. And then I wrote a savvy annuity guide, but I will tell you, this one's my favorite. It'll include annuities in it, but I wanted to make it all encompassing for you. So Go ahead and download it for free. Let me know what you think.
So great question. So basically step up in basis inside of
Yeah, no,
unfortunately.
Unfortunately, these are one of the worst inheritance assets out there. Your beneficiary would be taxed at ordinary income. There is no step up. There's also estate issues and income reportable to decedent, but we're not going to talk about that. These are not very inheritance friendly because there is no step up in basis with those funds. It's going to be ordinary income. Now, the insurance company, I don't know if Connie's still on, he probably can chime in, but the insurance company will give you some ways to take it. Lump sum over a period of time. You know, there should be some settlement options, but the pain is the pain. It's taxed to your heirs, and it's included in your estate. So
Yeah.
I don't look at these as legacy assets to any degree, in my opinion. So,
all right. So talk a little bit about a company potentially investing in annuities. So Derek here mentioned, you know, a firm has a lot of cash sitting in money market and believes at least some, maybe not all, should make its way into some form of annuity. And there can be some hurdles associated with that. You may want to distribute funds to owners. That may be a more, I would think, depending on what type of an annuity you have, it may actually be a better use of funds. Have they already been paid? Have you already had taxes paid on them? You know, there's a lot of things that may provide more liquidity, because if you have these proceeds setting aside, I know you've mentioned it, they were short-term assets, you may be better off looking for bonds or short-term bonds for a little bit more yield, ladder out CDs or, you know, things of that nature. That may be better. So keep that in mind. We had a question from Joel. How's the RMD calculated? Do they look at annual payment cash flow or cash value balance? That is actually, they're going to look at that 1231 balance based on your age. That's how they're going to calculate your RMD. Joel had a couple other questions as well. So we die before the cash balance goes to zero. The cash balance is paid out as a death benefit. Is the death benefit taxed any differently than if the annuity were not wrapped inside of an IRA? So if it's not inside of an IRA, your proceeds, what you put in, they're going to have what you call an exclusion ratio. This is going to be, if you're alive and you're taking distributions from it, they're going to look at the amount that it's grown and then your gains, and they're going to look at what you put in. And then that, based on that formula, it's going to tell you how much they're going to tax of that each and every year. It'd be similar if you pass away. How would the tax be calculated if the annuity were converted to a Roth IRA? Is this even possible? Yes, it's possible. You would typically want to pay the proceeds out of pocket and move the funds to the Roth. Keep in mind, it may not be the best tool, but you could certainly do it. I think we've gotten through most, if not all, of our questions.
Yeah, we got any closing comments? You go, Danny. What do you think? What's closing? Except get to your right, get to your left. What?
The biggest thing with the annuities is make sure you're planning for it. Run a financial plan. I know I'm beating a dead horse, but if you just go out and buy an annuity, how do we know that it works with everything else? So you really need to take an inventory of assets, of income, of expenses, and understand exactly how and why you would use it. There's so many different types. There's lots of bells and whistles. There are, like you mentioned, somebody mentioned 10% on the radio. I can go and find really high rates of return. That doesn't mean it's always the best thing. We could go look at a fixed annuity, a MYGA, multi-year guarantee annuity. And are we doing it with a fly-by-night company, or are we doing it with somebody that's going to be there where we're not worried about it? Most people are utilizing something like that. You want peace of mind. You want longevity. Look at their credit ratings. And that doesn't mean everything. But I think it's really important that you plan for it. It's really important that you understand what you're getting yourself into and understand, this is something that will typically not provide a massive amount of liquidity. You can typically make a distribution of 10% a year from them, but is that what you want to do based on the type of annuity and based on why you are using it? I think that's the biggest part of it.
Don't be afraid of annuities. They're good things. It's how they're used that you don't like. to Danny's point, don't just go and purchase an annuity. You need to fit this into your overall retirement plan structure. And if that person selling you the annuity doesn't know anything about all your other savings and ways to mitigate risk, you should not be purchasing an annuity until you know. Okay? Because people get oversold on things that they don't need. So embrace maximization of Social Security. Understand that's your annuity for the most part. Do proper things. Don't get caught into headline fodder that it's going to disappear and I got to take it sooner rather than later. If you have a spouse, especially a younger spouse who hasn't paid in as much than you are, then you have to consider survivor benefits. So annuities can be your friend, unless you're Ken Fisher, money man Ken Fisher, who doesn't like annuities because he's got billions of dollars. So no, he doesn't need an annuity. But we all could possibly use one, depending on our longevity risk and what we want to leave to heirs. So we really appreciate you being here. Our Candid Coffees are designed to be Q&As, back and forth, questions you have that you want to address, and that's important. And then our learning series that you'll see coming out is more topic specific. So if there's anything you want to talk about on these Candid Coffees, a topic you would feel would be important, hey, let us know. We want to know that information.
Take the survey. Let us know all the things that we need to do. The other thing I would say, if you want somebody to visit with, to take a bird's eye view, kind of give you an idea of what you should be doing or shouldn't be doing, you can also ask for somebody to contact you there. We'd love to visit with you. We have a great team of certified financial planners that would love to point you in the right direction, give you some advice, or just make sure you're armed with the best tools and resources available. But hey, thank you guys for joining us. We're just over an hour. We will see you guys shortly. Y'all have a great weekend, and we'll see you soon.